Good morning, everyone, and welcome to the 18th episode of the Capital League Insight series of webinars. The topic for today's discussion is 10x in 10 years. Exciting indeed. We are today discussing this topic in the context of wealth creation. Wealth, as we all know, is the ownership of valuable resources, and wealth creation involves the building of assets by means of careful investment, usually over a long period of time, so as to achieve an income stream for various financial goals. Wealth is not earned, it is created. And wealth creation is not synonymous with just investing. Though the process of investing in assets, of course, is crucial in creating wealth, however, investing is not always straightforward. If done correctly, following the principles of identification of financial goals and their time horizon, understanding one's risk tolerance, creating an appropriate investment strategy and framework, and above all, having the discipline and patience to let the plan work, will eventually lead to wealth creation in the long run. Now, there are several mathematical principles that are extensively used in the field of finance and investing, and these form the pillars of long-term wealth creation. One of them is compounding. Einstein famously said, "Power of compounding is the eighth wonder of the world." And Warren Buffett, who is one of the richest men in the world and the most revered and successful investor, has said, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." So, can mathematical principles alone do the trick? Or is there much more which we need to do to make sure that they work in our favor? So to gain insights into some of the principles of investing, successful frameworks, and various investing styles followed by asset allocators and fund managers, I would like to welcome Rahul Rathi, Chairman, Purnarth Investment Advisors. He has nearly 2 decades of hands-on experience in the fields of investment and risk management, having worked with financial institutions in the US and Europe before founding Purnarth. His deep understanding of data and trends relating to markets and businesses has brought forth insights for long-term wealth creation. Thanks a lot, Rahul, for joining us today for today's webinar. Welcome.
Thank you, Rajal. It's a pleasure to be here with you and all of the Capital League team and participants.
Thank you so much for your presence. We are indeed very grateful. So before we start the session, I would like to mention that we shall have a 15-minute question and answer session towards the end. So request you to please type your questions in the Q&A section at the bottom of your screens and address them to the panelists. So I would now like to invite Rahul to share his thoughts and insights with us.
Yeah, thanks, Rajal. I was just looking at the attendee list, and what I'd like to do, given the attendee list, is share my journey about how we thought through this whole framework of compounding using my own experience. In 2001, I started with 1 lakh rupees. And the idea really was that how do I start compounding that kind of money? In 2007-8, fortunately, because of the business I ran, I did get some money, and that's where we started thinking about compounding. So really, it's a journey. The framework is a journey of investing our own money and trying to find a framework where we can comfortably invest our own money. Let me first start with, what does compounding really mean and why it was very important as one of the wonders of the world. It's a principle of maths that is applied in finance. But this principle of maths, Rajul, connects 2 things which are very important for everybody's life. First part is money, and the second part is time. There are very few things that connect time and money so elegantly as what compounding does. So everybody has two things on their balance sheet. One is time and money. Once you take time forward, you can never reverse it. It's gone. What will change is money can go up and down, but time can never ever come back. So how should you think about time and money? Is this principle of compounding? And let me put it in a mathematical formula. And the example that I thought to myself, and I'll share what I did to arrive at the framework for investing for myself, and that's how Purnartha was born. Mathematically, given that I was a student of operations research and a certain affinity to maths, I said that however I invest my money, I want a certain mathematical background to it. So what we thought was that, and this is an example, 26% is doubling every 3 years. And as a businessman, my first 8 years, we did compound at a faster pace than that. But we said that 26% is a good number to look at mathematically, doubling every 3 years. 6 years, it's 4x. 9 years, it's 8x. And 8 into 1.25 is 10x. So it's an elegant framework to say that, okay, 10x in 10 years means I need to compound by 25 to 26% year on year. And in 20 years, 10x in the first 10 years and 10x in the second 10 years is 100x. And I said, that's a great goal to work on if that works. And what we realized was that for 100x in 20 years, what are the critical things that will break that 100x? And what we said was that we looked at it mathematically and we looked at it empirically. So let's say if I was invested for 14 out of the 20 years, and instead of 14, on average, most people are invested only 14 to 12 years. But let's take if I was only invested 17 out of those 20 years. What happens is that because you double every 3 years, your returns come down to 50x. Imagine in 20 years, you have a situation like COVID, you have other things that keep on cropping up. And in spite of all those things, what really happens is that you miss out on certain time in the market phenomenon. So really, what did compounding mean mathematically is time in the market versus timing the market. Unless there is a certain liquidity risk, as we are learning right now, but most often than not, for a large percentage of time, it is really time in the market versus timing the market. And I said, okay, let's check that out empirically. When we started investing, I attended AGMs of companies that had done 100x, over 20, 25 years, the Asian Paints of the world, the Infosys of the world, the Pidilights of the world, etc. And every time I used to attend an AGM, what I did was try and speak to people who have been attending the AGM for 20 plus years. And Rajal, I used to ask them that, oh, you've been attending this conference for 20 years. That means this particular share has given you a 100x return over 20 years. And to my surprise, 80% plus said, no, it's not given us 100x because we didn't stay the course. And the challenge really was that 75% of the people on average stayed invested for 12 years or more or less over a 20-year period, because behavioral finance started taking over, or decisions based on behavior started taking over. And the loss on the portfolio also created situations where people took actions based on where their portfolio was, versus where time was. The key
You're saying it
insight,
was more sentiment based rather than rational decision making.
right? Well, and it happens to everybody, right? Given where they are, emotions do drive things in decision making. So when I looked at the formula in finance, what I realized was that in finance, it really meant staying the course on spending time in the market. And that is what was the key learning from my whole experience of looking at it mathematically, but also collecting empirical evidence around, which people have been able to compound much more than others. Um, so the first key insight that I had was that I needed to find businesses where I could stay invested for longer periods of time than shorter periods of time. So the thought process was about identifying businesses where longevity was more important than trying to time the market. And what I said was, if I invest in a business today, what will allow me to stay the course? I can't say after 20 years, if it's not delivered, it doesn't make sense for me to stay invested. So I've got to find certain things that allow me to stay invested through the ups and downs of the business. And what I found were two parameters that were consistent with this kind of strategy or philosophy. The first part was I inverted the question to say that if I have to stay invested in a business for 10 or 20 years, the first important thing is that the business should not fail. I should not be in a business that kills a business. And what we realized was that if the business is debt free, they don't have any leverage, then you know that there's very little chance that the business will fail. It will be there, but it's not going to fail or it's not going to go under. So the first principle that we looked at was for businesses that continue to deliver on a certain risk parameters was debt free. The second part, Rajul, was a certain volume growth. So we realized that if the business had a 10% volume growth, it was relevant to its customers. So think about this, like, we are in a competitive world, and if we can grow our volume growth by 10%, which means that there is a consumer that is willing to buy our product after evaluating us from our competition and saying, okay, this makes sense, let me be part of this particular service or products. So sorry, you're saying something?
No, just carry on.
Yeah. So what we realized was that if we track volume growth, which told us that the business was relevant to its customers, and debt free, which also told us that the business was able to generate profits and did not need to borrow capital to grow its capex, which is capital expenditure and working capital. They were in a sweet spot in terms of pricing as well as volume growth. So those were the two principles that we said that are a framework to try and harness the beauty of compounding. When I wanted to invest my own money, I said that while this sounds great, what are the risks to the framework? And what we found there were three risks to the framework. The first risk was, that I will make mistakes. And out of every 10 decisions I take, 3 are absolutely wrong. And I've learned more from my mistakes than from my successes. So I said, how does this framework manage? How should I think about my mistakes and the challenges that come from mistakes? Um, and what the second risk was that there were external risks. Like a COVID was an external risk, the current environment is an external risk, and there are multiple external risks that keep on cropping up over a longer period journey. And the third thing is that if I have to stay in a business that is high quality, so I might get an advantage for the first few years, and then it becomes a well discovered business. And once it becomes a well discovered business, valuation premiums also take over, and the businesses sometimes become more expensive than when you started out with. So there is a certain valuation or a premium attached to a high quality operating business that starts coming. What we realized was that all three risks were looked at with one parameter, that was even if I'm down because of all the three reasons, how long do I take to recover back to the original peak? So let's say I have 100 rupees today, and because of this reason I'm down to 85 rupees. How long does it take for me to be back to 100 rupees? And what we found was that 10% volume growth and debt free, almost 95% of the times we recovered within 6 months. 2 to 3% of the times it took us about 6 months to 1 year, and there has been an isolated event or a couple of events where it took longer than a year. But almost all the times, if there is a certain volume growth and debt free, the recovery pattern was very high. The second thing that we looked at was there is a pain to sell your losers. There's a behavioral impact. Let's say I've done all the research and I find that circumstances have changed and I made a mistake, and now I have to sell it at a lower value than I bought it at. That was another challenge, which was a behavioral challenge that we had to kind of move over. And when we looked at that mathematically, what we saw was that, let's say if you have 100 rupees and you make mistakes over 50 rupees, and 50 rupees is the right bet and it continues to compound, the 50 rupees that you have made a mistake over, let's say, becomes 25 rupees. And the other 50 rupees that you have done well, it grows to 1,000 rupees. The risk is not cutting the mistakes, but the risk is really not letting your winners ride to 1,000 rupees. So what happened for a lot of people behaviorally was they saw losses and they tried to average out for those businesses, and while selling their winners. So when we looked at a lot of portfolios, the mindset really was that you continue to buy companies that have come down versus companies that have delivered and continued to do well. And in compounding, where that started hitting you was volume growth started coming down at a portfolio level, or you stopped being debt free. So adjusting the portfolio to cut your mistakes and continue with your winners was another part that we looked at in the framework, while we looked at how do we build a framework for compounding in the overall scenario. The third part that we learned was that, there are going to be potential times when you need to add money to take advantage of the situation. And the way we think about this, our portfolio in terms of valuation, is currently the portfolio, we look at operating cash flow. And I don't know if I'm getting very technical or not, but I'll just complete Raju?
Yeah, and you can elaborate on operating cash flow part.
Yeah.
Why do that?
So the two parameters that are very important from a layman perspective is, first is your debt increasing, and the second part is what is the bank balance year to year. End of the financial year, how much has your bank balance grown by is a good measure of what your cash flows are. And this is a oversimplified example of what operating cash flows mean, but it's a decent directional indicator of what it is. Operating cash flows is PAT plus changes in working capital minus taxes in terms of the real formula. But if I look at just evidence based, it's really what are the changes in the cash in the bank balance that's there. Either method is a reasonable method. So if cash balances are growing and that cash balance you invest in capex, it's a great business, because that means that you're comfortable with the growth in the business and you're investing in the business. At the same time, your bank balances from the business are going up. For us, understanding what we are paying for historical operating cash flows was our valuation metrics. And what we said was, let's say today it is generating 3 rupees cash flow and I'm paying 100 rupees for it. The yield is 3% at a portfolio level. There were times, and a 3% yield over a compounding of 20-25% gives us a yield over 10 years of between 22 rupees to 28 rupees is where the journey is. And if we can in another 10 years grow it to 280 rupees, that to us is a great model of what compounding does. But there are times where, because of liquidity crisis, you can build a portfolio at a 5% or a 6% yield. So the cash flows are 3 rupees, but the price that you're paying for those cash flows is 50 rupees. And you will get once every 5 to 7 years these opportunities to kind of top up when the yields are lower. So what does that do is that from a 3%, if I can build a cash flow at 5%, I've saved 3 years of my journey towards 10x. So we find that the market gives us opportunities every 5 to 7 years to be able to kind of add on when your yields for good businesses become more attractive. And what we think about compounding really is in terms of time. For a 10x journey or a 100x journey, can I save time? If it becomes faster, or if there is a factor of safety that comes in because of yield, you have a runway that is much better. So if you look at our site, we've actually delivered a 10x in 8 years in spite of our mistakes and other things. And what has happened is that right now, because of the drawdowns that have come in, it's come down. But we are seeing a lot of the older people saying, oh, the yields have gone up, which means there's an opportunity to buy. And that's when you can decide how to increase or how to change your asset allocation towards taking advantage of the markets, as long as the fundamental principles of compounding, which is volume growth and debt free, continue to be there.
Rahul, if I may interrupt you for a second, I just wanted to clarify. So when you are saying that when valuations are attractive, one needs to buy more. So is that not the same as trying to time the market?
That's a great question. The thing about timing the market is really saying that if the market gives you opportunities, should you ignore it or stay the course? We cannot say. So India is a market that overreacts to news. and it's just our culture. You know,
Only India? Is it only India which overreacts to news?
you know, sensationalization is something. So if you listen to Arnab, you know, if you look at the US dollar rupee trade and how, you know, India's become cheaper because the dollars moved in a certain way, and you see how animated he's about it, and you talk to Indians in the US who've also been hit in their NRE, NRO accounts about this, they're not as perturbed as there are people here. But as a culture, you know, there is a certain level of dramatization that does happen within India, and I love that. I love the fact that I don't have to pay for somebody to listen to me. I go down. There are friends, there are family that you can speak to without paying for it, which is what is happening in the US. But the point I'm driving here, Rajul, is the fact that our society, because of our communication, because we live in a certain way, dramatization, especially in our news, in our communication, is part. And this communication provides opportunities.
Mhm.
I wanted to give you that example, but it's there in data also.
So how does one make sure they have liquidity to take advantage of those opportunities then? Because if one is fully invested, because you want to harness the power of compounding over longer term, then as per your asset allocation, of course, and how does one make sure that you're able to
you have a certain cash in your asset allocation to be opportunistic.
Mhm.
So Rajul, so for me, there is, my investments are fully in equities. I'm very, very largely overweight on equities. And because I want to be there, but not everybody can be that aggressive because they're not that close.
Sure.
So
Yeah.
so when they're not there, they should have a small part of capital, and the percentage, I've done some work mathematically, but it can change for different people depending on where the cash flows are, to have an opportunistic bucket that's there. And this opportunistic bucket in asset allocation allows you to add at different points in time. And it also allows you to create that opportunistic bucket again after 3 years by reallocating to this particular to this particular thing. So while I believe in the longer term of things, a certain asset allocation to build and to put in the opportunistic bucket when the opportunity presents, and to cash out and keep that for a certain later time, 3-4 years later, is a good asset allocation tool. And ICICI, I think, has a great asset allocation fund. Pru ICICI has a good asset allocation fund, and there are times it's dependent on 4 factors, and there are times when it says, though, they want to be 80% in debt.
Yeah,
That's
there are
when,
several asset allocation funds like that.
yeah,
which do that based on various parameters. Yeah.
Yeah. So those are good indicators to when to, book profits in your opportunistic fund and keep it as an opportunity, versus when you should be opportunistic.
Sure.
I think, while I will not do that personally, but I think for people who have an asset allocation strategy, and there is a certain view, I think this bucket can create a certain level of
Partly when you rebalance the portfolio as per asset allocation, this objective is met to some extent. So if equities have corrected and on your asset allocation, it reduces by, let's say, 5%, then that is a call to move from debt to equity. and vice versa. So yeah, it does happen if one is following asset allocation strategies. I also had a question on, let's say if markets corrected during COVID and now the recent turbulence. So what kind of homework do you do to stay convinced on your holdings? Because external environment could seem as if they will, change the very fundamental of those stocks, or there could be some disruption which is around the corner. So what do you do to stay convinced and stay the journey? Because that is where most of us fail.
All right. So one of the things that allow you to, so there are two paths, okay? Can you, Manish, I have my colleague Manish here, and I'm going to share the GDP data. Can you share this GDP data out there? So there are two parts, two slides, which I'm going to share today, which allow you to be convinced. Can you move to the GDP data, please? So
and make it full screen so it's clearly visible.
Is this visible?
Yeah, this is better.
I've plotted GDP growth from 2001 to 2015. Okay, this includes the 2008-9 period. Okay, this was the crisis, and the reason of plotting this is that we have never been negative. Our GDP growth when interest rates were high, and after 2009 when interest rates were low, you look at the GDP growth of the country. There's always been a certain positivity in spite of any crisis that has happened. This also reflects in the growth of businesses and a certain level of trajectory at an economic level. If you go down to, the second part is, I want you to pull up the small cap, mid cap, large cap, this thing. So one of the things that gives us conviction is that India's GDP growth is rock solid, and the drivers driving it continue to stay rock solid. So you're able to move through some of the troughs of valuation because of a certain growth that the country has. The second part is, can you see this, Rajul?
Yes, I can see.
Okay. I'm sorry. Do you remember 2017 to 18, Rajul, the
Yes.
small cap and the mid cap index, crashed because of a liquidity crisis.
Right.
So the second part is to ensure that your portfolio on the equity side has a certain liquidity criterion. The only reason why equities have failed or have gone down to a lower value when there is a liquidity crisis. If you move to the next slide from 2017 to 22, and he'll share that data. If you're part of an illiquid portfolio, see, I showed you from 17 to 22, the small cap index is still negative. And the large cap index has outperformed the mid cap index. When you look at the last 3-year returns and you see small cap and mid cap doing well, that's because of liquidity driving down, or lack of liquidity driving down illiquid stocks to a valuation where the opportunistic capital should have come in and taken advantage of it. But if you would have bought it at the wrong time, then you're going to underperform liquid asset classes. So understanding liquidity or illiquidity premiums is a critical part in the cycle. And as long as your asset allocation, so ensures a certain liquidity premium or certain liquidity to your equities portfolio, your ability to move to a certain level of illiquidity when the opportunity presents in terms of drawdowns is an important allocation or change when you look at changes in environment. Can you close this? So in plain English, Rajul, what we are saying is that there are two risks which hurt long-term wealth creation in portfolios. The first risk is a lack of liquidity in the portfolios, and a lack of liquidity in your equity portfolios hurt long-term wealth creation. And the second thing that hurts is your ability to understand why to be invested when you have a drawdown.
Right.
Is what hurts long-term wealth creation.
True. So yeah, please carry on. I had interrupted you earlier.
No, I'm almost done. I can share a lot of data on how I pick up stocks, but that's not the real thing. The real the objective of today's topic was to share the framework and share some of the risks that come with it and how do you deal with them.
Okay, so one of the questions I had, that you mentioned that you specifically look at debt-free companies, and in your experience, they are the ones which have given high returns year after year, and they have pretty much stayed the course. But I mean, one is taught, or one is always told, that debt is cheaper than equity when you need resources, and they provide a runway because of which you can leverage your company, you can expand at a much faster rate than you would otherwise do if you were to just grow with internal accruals. So what do you think of that?
Rajul, debt is a behavioral challenge. So let me give you an example. Okay. Let's say you have 1 lakh rupees to invest. And the objective is capital, wealth creation and capital protection. Okay. So 1 lakh rupees is there, and you invest in an opportunity that meets this criterion. Okay. Or you invest in a project that meets this criterion. Okay. If it's your own business. And 2 years later, you find that you made a mistake. What do?
You're stuck. I mean, you still have to repay your loan.
No, there's no loan here.
So right now there's, okay.
What do? This is your own money you've invested, and you find that you made a mistake. What do?
I mean, you stay put, hoping it will do better, or you cut your losses and exit. Yeah.
So most people, so what would you do? You have two choices, whether you stay put and you find out that structurally you made a mistake. What do?
Cut losses, exit.
Cut losses, right? Let's say if I give you an example where you have an opportunity, but it requires 2 lakh rupees and you have 1 lakh rupees. So you put your 1 lakh rupees and you borrow 1 lakh rupees and you invest. And 2 years later, you come to the structural problem. What do?
Then you have to stay put and try to make it work.
In 20
because
seconds,
you're obliged to return the money you borrowed.
In 20 seconds, you've changed your answer. The economic answer is a mistake, is a mistake, is a mistake.
Right.
But debt creates that challenge to change your decision making. And out of every mistake you make, if you delay decision makings on cutting your losses because of leverage, it becomes a huge problem. So a lot of the decision making or the stringency in decision making changes because of debt. And we have seen that in many companies.
But all companies today who you have identified as debt free, they would have had taken leverage at some point of time in their initial days.
You
So
know,
are we then only looking at mature companies who don't need leverage anymore because they have enough internal accruals now, or
you
they
know,
don't require fresh capex to keep growing at a certain rate?
so think about a petrol pump attendant, Dhirubhai Ambani. If he wanted to start a business with debt, do you think he would have ever reached the levels where he was? He always converted everything into equity. When you want to stay competitive and the opportunity is large, equity becomes a much better play than debt. So when you make a mistake, your lenders are sitting across the table and you lose a lot of time trying to convince them. Equity people are with you and you can continue to grow. So for businesses, finding the right relationships within the food chain and participating in growth, but also ensuring that losses don't cut you or you're not on opposite sides when you've made a mistake, is why leverage plays a very important role in managing the environment when you are down. And having no leverage, we've seen that companies take better decisions for the environment rather than taking short-term decisions.
So Rahul, when you apply these two criteria of debt-free and 10% volume growth, does it not make your basket of opportunity very small?
It does. And we are okay with it because, so the other thing is we talked about recovery, right, Rajul? Let's say you have, there was a blow up in Franklin Templeton's debt fund.
Yeah.
You remember that, right? Yeah. Imagine if you had a 4% loss on a debt portfolio. How much time will it take to recover that?
1 year.
1 year, right? But in equities, if you're in the liquid portfolio, even if you're down 25%, you've recovered within 6 months. So time to recovery is a better measure to look at. And what we have found is that debt-free companies with a certain volume growth recover much faster. So let's say if I build a 50 stock portfolio, my recovery is dependent on the market. It's not earnings driven. If I have a concentrated portfolio, my recovery is dependent on earnings, not on the markets. Because my high conviction bets in a 50 stock portfolio is 20%. So I'm okay because my recovery drivers are driven by concentration.
So they do not behave in line with market, you are saying, because they are such strong stories or such strong companies in the first place.
That's right.
I mean, typically they can at the margin move against the market. They could be outliers.
And even if I made a mistake, I can reshuffle it to get the right ones. In a 50 stock portfolio, reshuffling is not possible because my weightages are limited.
So, okay. So coming back to one of the things you mentioned about India's GDP, and you said that there are certain drivers which are making sure that we continue to grow at a certain rate. So could you talk about some of these drivers which will drive growth in India over the next 7-8 years, and the forces which you think are there which will transform India over this decade?
Right. The first driver for India is GDP per capita. We are at $2,300 GDP per capita, which means that roti, kapda, makan drive India's GDP growth. Okay. So essentially, a person, even after the Bombay blast, the next day trains were working. Yes, people needed to work. You didn't get money to stay at home.
Right.
A large percentage of India continues to work to satisfy basic needs. And that is what drives a certain amount of resilience in India's GDP growth. The second part is, there's a tipping point. If I look at the total credit demand in the system and what percentage of it goes to the government versus businessmen. In the US, 100% of banking credit goes to private enterprises, which means that US's GDP growth is driven by private enterprises. In Pakistan, 90% of it goes to the government, which means that a large percentage of the GDP growth is government dependent. There is a tipping point when the country's GDP growth is driven by businessmen and not by the government. Then you can bet on it, because there is a certain creed for businessmen to continue to deliver on a certain growth. It's not necessarily the same objective for other players. And we cross that tipping point. And because we have crossed that tipping point, our GDP growth is driven by businesses, not by governments.
So what is this ratio in India?
That's my IP, Rajal, that's a different this thing.
Sure.
But I've spent a lot of time studying countries across the world to identify what that tipping point should be and how GDPs have changed, in different countries. There are government-driven GDPs and there are productivity-driven GDPs.
What about China?
China is still government-driven GDP. But you can't, so, while it's a statement, the question, Rajul, is, can I believe data from China? So my answer is meaningless because I don't have credible data to say yes or no. So I can give you a directional answer based on the data that we have studied. But I'm not sure about the authenticity of that data. That's all. I want to make that disclaimer in something.
Sure, no problem. So what are the other indicators you were talking about? This
I
was
think
one you said.
These are the larger ones. Then you look at how levered the whole system is. You look at whether there is too much leverage, then there is a challenge to that. You look at whether there's enough liquidity in the system. But these are all second order. The two main things. So, what is a crisis? A crisis is when historical data is so bad that the future looks bad, right?
True.
It's like, let's say you're analyzing a portfolio in March of 20 or March end of 2020, and you're seeing equities down 30%. And you're saying there's COVID, what's going to happen to economy. So data itself is bad. That short-term data is bad, but if you spread it out over a certain period of time, you know how the recovery will look like. And that is why I plotted the GDP growth in 2008, and if I plot it from 2020 to 2024, you'll see a certain bounce back also in GDP. So these are things that will drive recovery in portfolios.
So what is your take on wealth creation opportunities, since we're talking about wealth creation here, for Indian investors in the long run, let's say the next 8 to 10 years? What do you think? What kind of wealth one can create?
I think that the wealth creation opportunities remain the same as they were in the last decade. I don't think there's anything changed. And every decade across the world, there have been opportunities. But what has changed is earlier it was sectoral that drove opportunities. So if you look at the 2000s, it was on the 1990s, it was IT. Then between 2000 to 2006, it was infrastructure. Then 2016 to 21 was the chemical sector. But I really think that for my style of investing, which is longer term, business models create wealth creation. I think that there is so much liquidity available in the system that if you don't have the right business model, you will not be able to survive competition. So there could be cyclicals that will have a certain growth trajectory over a shorter period of time, and you'll have to keep on churning those things. But for if you want to stay invested longer period of time and you want to identify the winners over longer periods of time, you'll have to focus on business models and identifying moats in a business model, and how they continue to create those becomes critical. And it's really boils down to cost advantages. So is the company doing something to be a cheaper cost provider over a period of time?
So essentially, since you said that opportunities are the same in the current decade, what they were in the last decade, and you did deliver 10x in 8 years, or let's say even if it were 10 years as of today, you see the same opportunity going forward, that you have enough options to create a basket of portfolio which can deliver a similar kind of return?
Yes.
So are there any external forces which are at play which could take away or add to this opportunity?
Yeah, it's there are 2-3 things that that I think would take away this opportunity. The first thing, really, in the last 2 or 3 years, what we've realized is that a lot of the smaller names, because of the advent of PMSs and everything, are getting discovered and getting increasingly well researched, and there is a value premium. So if I buy a good business model but buy it a little more expensive than I would have started out with, so that would change. But if so instead of a 10x in 10 years, if I bet on the right business model, I might do a 10x in 12 years, or a 10x in 13 years.
Right.
So ITC, earlier from 80, it delivered 1,000x from 70 to 2005 in 35 years instead of 30 years. So 10x, 100x, 1000x. So if you buy it at the wrong valuation, you compromise the 10x in terms of time. And I think that somewhere that will happen. If I don't find the opportunities, or I get great businesses at a little more expensive valuation, that's what will happen. But it will be covered over 12 years. So it's like a marathon. Instead of running in a certain period of time, you might take a certain 25 minutes extra or a 30 minutes extra, but you'll reach that goal. It's just the time constraint will be violated, not the 10x part.
Sure. And one of the things you mentioned, GDP per capita. So do you think that some of the reforms which have happened in the last 5 years will accelerate that increase? I mean, China is at $10,000 per capita. Etc. Everybody is at 40, 50, 80, whatever, and we are pretty low there. Does that create a base for opportunity?
I don't know that, Rajul. I'm hopeful. Historical data doesn't show it. So I want to see a $10,000 GDP per capita, sooner than later. But there's no historical data to support that.
Can we, how fast we will reach there?
It's a guess, right? So I'm hopeful earlier than later, but nothing in the data to support any trajectory which is meaningfully positive.
Sure. Okay, let's look at a couple of audience questions. So there is one that during the long journey to stay invested, on what parameters an investor can decide that this is the right time to liquidate the assets and sit on cash and wait for the drawdown opportunity?
The ICICI Pru Asset Allocation Fund does that. There are a couple of other indicators also. which kind of tell you whether the market is overbought or oversold. That particular fund is almost a fundamental fund, but it's a decent directional fund to be able to kind of look at that. But the point is, the difference that I have is that I will look at the opportunity bucket, and I would not look at a traditional asset allocation. So you have an equity asset allocation, you have a debt allocation, and you have an opportunity bucket. Now, what percentage of your fund should be in the opportunity bucket is a different is a different topic, and as long as what it should be. But the other two buckets, you should stay the course as long as the equity bucket is not illiquid. So as long as you have a traditional allocation where there is a focus towards liquidity, the opportunity bucket should be able to take advantage of illiquid opportunities and the mispricing in illiquid opportunities and get there.
Sure.
So my short answer to this, Rajul, is that a larger allocation should be liquid and have some buffer money. Whenever markets get illiquid, jump in, because you'll get extremely good pricing opportunities there.
There is a question on the real estate sector. We see a revival, but do you see a more sustainable bounce back? And will the current high interest rate environment hurt the revival?
The longer term data for real estate has risk on one parameter, is liquidation. So when you want to move out of real estate into other asset classes, it kind of violates the liquidity risk. So unless you're very sure that you're never going to sell it or never going to transfer assets to the next gen, or going to transfer it and they don't have to sell it, you're okay with real estate. But the liquidity risk is a huge cost to pay, because I know very few people who've been able to sell their real estate at the price that is quoted when in the market. Whenever they go to sell, there's always a discount to what the prices seen are.
So Rahul, this is from the point of view of making an investment in real estate. But what about real estate being a sector which creates a lot of jobs and opportunities in the secondary and the tertiary sectors? From that point of view, are you excited by the turnaround which is happening now?
Oh yeah, absolutely. Absolutely. Means as long as I can see it in the GDP per capita, I'm very happy about it. Ultimately, it all has to come down to that one number, right?
Okay.
Yeah.
As a long-term trend, where do you see the dollar? And post Russia-Ukraine crisis, do you see an alternate currency system challenging the supremacy of US dollar?
So this question would be determined by the US actions if the US dollar reaches 80. I think every country. So during 2020, currencies were very stable. Here's a situation where there has been a huge demand destruction. But in spite of the demand destruction across countries like Pakistan, India, Thailand, Malaysia, you saw their currencies or the basket of currencies being very stable. Which means that the US Fed pumped in enough liquidity to support a certain currency in a very, very volatile and uncertain time. If they don't do that now, countries will start looking at alternative currencies. So India is comfortable till 80, but US action after 80 will determine whether there will be a certain alternative currency or not. But so far, if it takes action, then I don't think there is a question of alternative currency. So watch for US actions around 80, at least in the short term.
So Rahul, now since we are coming to the end of our time today, would you just give us a brief overview and a summary of your market outlook as of now? Everybody wants to know that.
My market outlook in the next 6 months is that the flow of money is dysfunctional. What I mean by that is India has an equity asset class where the domestic fund managers or fund managers domiciled in India are saying that it's a buy, and fund managers domiciled outside India are saying it's a sell. And that's been happening for a long period of time. The reason for this dysfunctionality is in the factor of safety. So common factor of universal factor of safety everywhere is valuation. So let's say if I want to invest in Bangladesh or Vietnam or US, I look at a valuation as a factor of safety. And obviously vis-a-vis other countries, India is more expensive. So as a fund manager domiciled in India, I look at that factor of safety where I don't see valuation as a factor of safety. I look at other parameters as a factor of safety. I say, oh, great business, great franchise value. Here's the capex that's going on. So because I don't have a universal factor of safety, I will have an idiosyncratic factor of safety. And this is the dysfunctionality between fund managers domiciled outside India and within India. And this would create opportunities to put your opportunity capital bucket to play between now and November.
Why do you say November?
Because I think a lot of the midterm elections will be over by then. The US midterm elections will be over, and the Fed will move back to an economic agenda instead of a political agenda.
Right. So between now and November, you think would be the best time to deploy?
To work. Yeah.
But do you see a further market correction?
Don't know. It's markets, there are times when markets are irrational and illogical. Two very intelligent segment of people are viewing the same asset class, and one is consistently saying it's a buy, one is consistently saying it's a sell. It's not a market, right? It's almost fundamental in its buy or sell decisions. That is not a market. That's just illogical. So I don't have any predictions about where things are today, and there's no data driven thing. I think the markets are just being irrational, and anything could play out, and I won't be surprised by anything. Markets might rally also, markets might come down also, but no real logic to which path it'll take. In November, I can tell you why my vision behind is 2020. But today, if you ask me, I think I'm as uncertain as there is, because I don't think they're logical. I can't defend any side logical.
Okay, I mean, any trade when it happens, there is a buyer and there is a seller, but consistently we have had like one group selling and one buying. And maybe they are part of an emerging market basket, and it typically happens that when dollar appreciate, risk capital flows out from emerging markets, and we are suffering as a collateral damage to that. And our valuations on a relative basis still remain much higher compared to other emerging markets, and rightfully so. And I think for those very reasons, the domestic investors are bullish, are buying.
So you can argue from either side, and both have relevant points of data to present why they're selling or why they're buying.
Right.
But I don't know which side has more staying power
in the short term.
In the short term. So that's why it's very difficult to predict what's going to happen. Yeah, one thing I can tell you, post-November recovery is going to be extremely fast. So the real challenge is not that. The real challenge is the uncertainty over the next 5 to 6.
That one needs to ride out the uncertainty and just.
Oh, of course. Actually, I'm quite opportunistic about it. I don't want to be pessimistic about this. You can view it saying that, whatever you've invested has come down, but you can also view it saying that, oh, it's an opportunity to put some money to work. So I'm not as worried about the volatility.
Great. Use it as our friend. So Rahul, thanks for some very refreshing insights into the principles and your frameworks of long-term wealth creation. I'm sure everybody found it very useful and had a lot of takeaways from our discussion today. And I would like to thank everybody for joining us on a Saturday afternoon.
Thank you. It's a pleasure to be with all of you today. Thank you very much.
Thank you so much. And I will request everyone to take 30 seconds out to fill the feedback form as you exit the webinar. Thank you everyone once again and have a great weekend. Thanks, Rahul. Bye.
Bye.